In this video, I'll reveal how much passive income I received in the last financial year, where it came from, and also how much tax on this income I had to pay. This is not financial advice, of course, and I'm simply showing you my own journey. Firstly, what is passive income? Passive income is the money you earn without having to give up your time for. I receive passive income from three sources: savings interest, premium bond prizes, and dividend payments. If your taxable income is up to a personal allowance of £12,570, you do not have to pay any income tax, and additionally you may also benefit from a £5,000 savings allowance. In this table, I'm going to focus on taxpayers' allowances, which will affect the majority of people. If you are a lower rate taxpayer, you are currently allowed to earn £1,000 in interest payments in a tax year without having to pay any tax on it. Higher rate taxpayers only receive a £500 allowance, and additional rate payers receive no allowance at all. Let's assume you have £30,000 in a savings account paying 5% interest. Lower rate taxpayers would receive around £1,500 in interest, but only £1,000 will be tax-free, and the other £500 would be taxed at 20%, giving you a net return of £1,400. Higher rate taxpayers would only have a tax allowance of £500, and the rest is taxed at 40%, leaving you with a net return of £1,100. For additional rate taxpayers, there is no tax-free allowance at all, and all the interest is liable for tax at 45%, a net return of only £825. I have a savings account with NS&I, and although I'm a higher rate taxpayer, I only receive £19 in savings interest, and as this is clearly below the £500 allowance, I didn't have to pay any tax on my interest payments in the last tax year. My second source of passive income is premium bonds. When you save using premium bonds, your money is safe and you can withdraw it in just a few working days. Instead of receiving interest payments, you have the chance to win a range of different cash prizes each month, ranging from £25 to a jackpot of £1 million. In the last tax year, I managed to win a total of £850 in prizes. With premium bonds, all winnings are tax-free, so again, no tax for me to pay here either. If you find this content useful, then please hit the like button, as it really helps out the channel. A third passive income source is my general investment account, where I hold some of my stocks and shares. Let's take an example of someone receiving £5,000 of dividends in a general investment account. In the 2023 to 24 tax year, investors in the UK enjoy a tax-free dividend allowance of £1,000. Anything above this is liable for tax. Someone on a basic tax rate pays 8.75% on any dividends above the £1,000 allowance. So on £5,000 of dividends, that would be a tax bill of £350. But in the following tax year, the allowance is being cut to just £500, leaving you with a tax bill of £394 to pay on your £5,000 dividends in that year. Those investors who don't actually take their dividends and instead have them automatically reinvested, it makes no difference. You still have to pay tax on the dividends in the same way as if they were paid to you as cash. For higher rate taxpayers, the rate is 33.75%, giving a tax bill of £1,350. And in the 2024 to 25 tax year, it will be £1,519. And here are the amounts you would have to pay if you are an additional rate taxpayer. So with a general investment account paying me lots of dividends, then surely I had to pay tax on this. Well, let's take a look. In the 2022 to 23 tax year, I received £1,293 in dividends from my general investment account. But the allowance for that year was £2,000. So again, I didn't have to pay any dividend tax for that financial year. And now for my stocks and shares ISA, which is a tax-efficient investing account in the UK. You can currently invest up to £20,000 of new money each year. There is no dividend or capital gains tax to pay on investments within the ISA. You can't carry over any unused allowance to the following tax year, and the amount invested is independent of dividends received. As an example, let's say your shares pay you £5,000 in dividends in a given tax year inside a stocks and shares ISA. As long as you don't take the money out of the platform, you can reinvest it whenever you like, and it doesn't count as new money. you can still put an additional £20,000 into your platform. This makes investing inside an ISA a really powerful tool to compound your wealth. In the 2022 to 23 financial year, I received a total of £13,123 from dividends inside my stocks and shares ISA. As I didn't take any of it out, I was still allowed to add a further £20,000 of new money into my ISA account. So that's over £13,000 of passive income and no tax to pay on that either, as everything inside an ISA is tax-free. Here is the overall summary. You can see at the bottom of the table in the last financial year I received £15,285 in passive income with zero tax to pay. I'll shortly discuss capital gains tax, but first just a reminder that if you are thinking about starting your own investing journey, then you might want to consider opening an account with Trading 212, a cost-effective platform for buying and selling shares. If you sign up using the link in the video description, then we could both get a free share worth up to £100. And now for capital gains tax. You are only liable for this when you sell some or all of your shares and therefore potentially realizing an actual profit. And even then you won't have anything to pay if your profits do not exceed the yearly capital gains allowance. You also have no capital gains to pay if you realize any profits within a stocks and shares ISA. The following information refers to shares in a general investment account only. For the 2023 to 24 tax year, you have an allowance of £6,000 and you would only be liable for anything above this amount. Let's assume you have bought some shares several years ago which have now increased in price and you decide to sell them for a £15,000 profit. For those in the basic tax bracket, a rate of 10% is applied, meaning you would have to stump up £900 to the Treasury. 2024 to 25 tax year, the allowance will halve to just £3,000, meaning you would be liable for £1,200 if you realised the gains in that tax year instead. For higher rate taxpayers, the rate is 20%, so if you sold and realised a £15,000 profit, then you would be liable for £1,800 in capital gains tax. If you sold in the following year, you would have to pay £2,400. To reduce this tax bill, you could offset losses against gains. Let's take an example and assume that you're a higher rate taxpayer and you want to sell Rolls-Royce shares which have risen sharply for a £9,000 profit. Your current allowance is £6,000, so you will have to pay 20% tax on the remainder above this amount. However, let's assume that your shares in Croda have made a loss of £4,000 since purchase. If you sell all your Rolls-Royce and Croda shares, your net gain is £5,000, and as this is below your allowance, you don't have to pay a penny in capital gains tax. Now, this is going to be far more difficult to do in future years, of course, because the allowance is going to be halved to £3,000. In my own portfolio for the 2022 to 23 financial year, I did sell a few shares outside the ISA, and this realised a capital gain of £758, so no tax to pay there either. To further eliminate the worry of capital gains and dividend tax in future years, you could start off using a stocks and shares ISA. A SIP or self-invested personal pension is another tax-efficient method worth considering, but I'll leave that to another video. In my own portfolio, I have both a stocks and shares ISA and also a general investment account, both with Barclays. I started the ISA a few years after I opened my general investment account, so I now have to be careful about what I buy outside the ISA. As I explained earlier, outside the ISA, I currently have a tax-free dividend allowance this year of £1,000, so I therefore try to pick shares with below average dividends. Unilever, Croda, London Stock Exchange, Relex, Rolls-Royce and my S&P 500 ETF all pay either below average dividends or no dividends at all. This means I can carry on investing even when my ISA is full. At the start of every financial year, I do what's called a bed and ISA transaction, basically scooping up £20,000 of the highest dividend payers outside the ISA and immediately rebuying them within the ISA. This means I use up my complete ISA allowance usually on the very first day of each financial year. On my platform there is a special bed and ISA transaction feature which does all the work for me, and I just have to select the shares I wish to transfer over. In the last financial year I transferred £20,000 of Unilever shares in this way. In future years, however, this is going to be far more difficult to avoid tax completely, but I'll do my best to limit it by holding all my highest dividend payers inside the ISA and growth stocks outside the ISA. I'm not too concerned about future capital gains tax, as this is more controllable and is a much lower rate than dividend tax. I'll leave a link at the top of the screen if you want to check out details of my entire portfolio and how it's performing. So to summarise, inside the ISA I can reinvest dividends without any worry, and I currently generate around £13,000 of dividends per year in this account. In this way I can allow the dividends to compound over time. I transfer £20,000 of shares each year from outside the ISA to inside the ISA using a bed and ISA transaction. All new money throughout the rest of the year goes into the general investment account. I keep low dividend payers or growth stocks outside the ISA as there isn't room to put everything inside. This strategy helps me avoid as much as possible the 33.75% dividend tax, and I'm not too concerned about future capital gains tax in the general investment account, as it's much lower than dividend tax and is more controllable and does not impact me from year to year. So it seems clear that if you are serious about investing for the long term, a Stocks and Shares ISA could be well worth considering. And if you want to know which Stocks and Shares ISA platform is the best one for you, then check out this video here.